In this video, we're going to talk about how to compute cash flow from operations when you're using the indirect method to create a statement of cash flows. So first, let's understand what cash flow from operations means. So we're talking about the net cash that's provided or used, if it's a negative number, by the firm's core business. And so when we say core business, that's what we mean by operations, right? So the firm, we're not talking about the investing, if they're buying a capital equipment or something and they decide to sell that capital equipment later. That's not really maybe part of their core business. That's just something they do incidentally. And we're not talking about financing either, right? So we're not talking about raising money through common stock. So this is not investing, not financing. If the money doesn't come from those sources, then we're going to say that it comes from operations. And this definition isn't perfect, but we're going to work with it for right now. And I'm just going to show you an example, a short example of how we go about computing the cash flow from operations. So let's say we have a company called Healthy Food Industries, and so we're going to need to know a few things in order to calculate the cash flow from operations, and we're going to need to know net income. And that's important because the first thing we're going to do when we calculate cash flow from operations, I'll just call CFO here, when we calculate that, we're going to start with net income, and then we're going to make adjustments to it. And the reason is that when we think about money that we're generating from operations, net income is a pretty good proxy. The problem is that net income is computed on an accrual basis, right? So this has accruals in it, right? And what we want to do is we want to make adjustments to the net income to convert it more and more to a cash basis. So what we're going to have to do is account for things like, for example, depreciation expense that are non-cash transactions, right? So when we're taking depreciation expense, that's reducing our net income, but that has nothing to do with cash. So we need to know, okay, we have $300 in depreciation expense, and then we have a $50 loss on the sale of some equipment. And so I'm going to explain why that's relevant in a minute, but what we're also going to need, aside from knowing these numbers from the income statement, we're also going to need to know numbers from the balance sheets. And in particular, we're going to have what's called a comparative balance sheet. So we're going to have balance sheet for 2 different years. So let's say that this is the end of year 1 of operations, that's what our balance sheet looks like, and then at the end of year 2, this is what the balance sheet looks like. And so we compare those 2 snapshots of the balance sheet of the firm's liquidity at those points in time, and we've got these 3 accounts that we're going to be looking at, right? In reality, a firm will probably have a lot more accounts than this, but we want to make it simple. We've got accounts receivable, we've got inventory, and then we've got accounts payable. So what we're going to do is we're going to look at the changes in these accounts, right, from year 1 to year 2. And then we're going to use those changes to actually make the adjustments to net income. So this might be a little confusing and when I just kind of talk about it abstractly. So let's jump down and let's think about how this would go. So remember, we're going to start out with net income. And our net income is that $4,700 that we talked about. So let's start with that. Now remember, net income has accruals in it, and we want to get to cash, right? We want cash flow from operations, so we need to make some adjustments here. So our first adjustment, let's remember that depreciation expense, right? When you take depreciation expense, you're matching this cost, right? But it's not an actual cash. When you have depreciation of $300, that's not actually paying out $300, right? So it's an expense, but it's not cash. So we're going to take that $300 and we're going to add it back to net income. Why are we adding it instead of subtracting it? We're adding it because it was deducted to get net income, right? If we think about our income statement, this depreciation expense reduced our net income. Our net income would have been $5,000 if we didn't have that $300 of depreciation expense. So we're going to add this back, okay? Now we're going to add back this loss, this $50 loss on the sale of equipment, right? So now you might be wondering, well, what? I don't understand how that fits in. Isn't this equipment, and wouldn't that have to do with investing? Well, yes, and let me just explain briefly how this works. So $50 loss, so let's say that the book value of the equipment, let's say the book value was $1,000, and then our sale price, so sale price was $950 on this equipment. And let's just ignore whether the equipment was depreciated or any of those things for right now. Let's just make this really simple. Let's just say that we had a book value of $1,000 and we sold it for $950. So then we have a $50 loss, right, on the sale of the equipment. And so the way this works is that the $50 loss is going to be added back to cash flow from operations because of the following. We're going to say this $950 that we receive, that's the actual cash we received. And we're going to put that under cash flows from investing, which I'm going to have another video on that. But it's not going to go under operations. Remember, investing is different. That's where we're going to account for the $950. But this $50 difference between the $1,000 and the $950, that's just we're saying we have a loss, but that really doesn't affect our cash, right? The only thing that affects the cash is that we received $950, and we're going to account for that in the investing section. But we have this $50 loss here of the difference between the $1,000 and $950, and it reduced our net income. So we're going to add that back because that was non-cash, right? We're accounting for the cash part here on investing. The $50, we don't really want to worry about that, right? That's just an accounting loss. So we're going to add that back to our net income as an adjustment. Now we need to start thinking about these accounts up here. Okay, so now we see that our accounts receivable, we actually had a decrease in our accounts receivable from 625 to 550. So it went down. So we had a decrease, and that's actually going to, we're going to add that 75 is going to get added. So think about it like this. We had a certain amount of receivables, 625, and the receivables went down. So what does that mean? All else equal, we're getting paid, right? The accounts receivable are accounts that we have where people owe us money, and if that goes down, that's a good thing. That means that we're getting paid. So what we're going to do is we're going to add that decrease in accounts receivable, we're adding the $75 there. Now, with inventory, when we look at our inventory, we're actually going up. We're going from $1,100 to $1,200. So we're going to have to, that's going to be what we call a use of cash, right? So we think of this 75 with the decrease in accounts receivable, that's a source of cash. We can think of this increase in inventory as we're actually using cash. Now, why you say, well, why is it use of cash? Well, think about it. We've got 1,100 of inventory, and we end up with, at the end of the period, the next period, 1,200. So when we think about the net effect, right? I mean, we might have bought 500 of inventory or whatever. When we think about the net effect of buying and selling inventory, we went up $100. And so we'll say that that cost us $100 cash. Now, you might be saying, well, hey, wait a minute. Sure, that cost us $100, but how do we know it was cash? How do we know that we didn't buy it on credit? Well, we don't have to worry about that right now because we're going to worry about that when we do accounts payable, which is up next, right? So when we do the inventory, we just say, look, we went up $100 in inventory, so that increase in inventory is going to be negative 100, and that's why I have it in parentheses to indicate that this is a negative number. This is actually going to be subtracted from that 4,700. It's going to be a negative adjustment. So now let's look at our accounts payable. So the accounts payable went up $30. So we're going to have an increase, and we're going to have that as a positive number. This is not going to be subtracted. This is going to be added to net income as an adjustment. And when we think about the accounts payable, this is what we owe to other people, right? We owe to our suppliers and so forth, and it went up $30, right? So that means that, hey, that was actually, I don't want to say a good or bad thing, but it actually is going to be a positive 30 that we're going to want to add, right? So we basically have this 30 was an extra $30 of credit. The amount of credit that we were extended by our suppliers for inventory or what have you that we bought, actually the net effect was it went up $30. So now we can go and we can add up all these numbers here. Okay, so we start with this 4,700 of our net income, and then we add the 300 depreciation. We add back the loss on sale of equipment. We add the decrease in accounts receivable of 75, and then we're going to subtract out the $100 increase in inventory, and then we're going to add the increase in accounts payable, and that's going to give us a grand total of $5,055. Now, we're going to call this, if you were to look at a statement of cash flow, sometimes it's different, but you'll typically see a net cash provided by the operating activities. Now, let's say, so this is a positive number, right? So it means that we generated $5,055 from operations in this period. Okay, but if we were to think about if this were negative, which it certainly could be negative, and you might wonder, hey, how could a firm possibly have negative cash flow from operations and continue to exist? Well, they might be able to, because if they're generating positive positive number from the amount of cash they get from investing or so forth, then we can have you can have a negative number here and the company still be in business, right? But we're not talking about financing or investing here. We're just talking about operations. It's positive. But if it's negative, it would say net cash used by operating activities. Okay, so provided basically just means it's positive. Net cash used means that it's negative.